Hello traders, the title of the video is how to combine the Elliott wave flat correction and volume trading. Alright, let's get started. Alright, so we are looking at American Express stock, Epic ASP, Alpha X-ray Papa, and we want to discuss how one can combine the Elliott wave flat correction and volume trading. All right. So the internal waves of the flat correction are 3, 3, 5. All right. So the flat correction is an Elliott wave corrective pattern that usually takes place at the end of a trend. All right. So here we have a bullish trend. I want to draw a line here because I don't want it to, because of, you see, I cannot zoom into this session. So I prefer to consider, going to put a pink line there. As we want to consider the pink line as the starting point of the trend. As you can see that in this session here, it went up a bit and then pulled back. So because I cannot zoom into it, I don't want to consider, okay, this level below here as the starting point of the trend. That's why I'm putting my line there. All right. So there was a bullish trend. Let's say from 1991, there was a bullish trend up to the year 2000. All right. So this is it, the bullish trend. And after that, you can see that the price came down. All right. See here, it went down like this. Though the internal waves are not very clear, if you agree, there was one move like this. Because I don't want to dwell on the internal wave or the flat correction itself. What I want to focus on is how to combine the flat correction and the volume trading. So I'm not going to go into what has happened here. So what I say to trader, when we had a flat correction after a bullish trend, one will always draw the Fibonacci extension, apply to the fifth Elliott wave to highlight the 138.2%, the Fibonacci extension level of the fifth wave. So this is the fifth wave right there, or this section here. One more time, I'm not going to go into the Elliott wave count this time, but you can take my word for it if you want to. This is the fifth wave here, and if we apply the Fibonacci extension to that fifth wave, and then we highlight the 138.2% level, that's the line that I'm going to color now into orange on my charts. All right, very often, if we have an expanded flat correction, not the classic flat correction, not the running flat correction, but the expanded flat correction, the B wave of the expanded flat correction very often will stop at 138.2% Fibonacci extension level of the fifth wave. This is what has happened here. So this is the B wave of the expanded flat correction. You can see that this is the A wave of the expanded flat correction. Here we can clearly see the internal wave 1, 2, 3, but this one here, it has been a little bit messy here. All right. So we have a flat correction, and this session here, this is the C part of the expanded flat correction. You can see that very often the C wave of the expanded flat correction very often can be very, very fast, can be quick and volatile. All right, because as the price goes above the high of the fifth wave, bullish traders think that the stock will continue to go up, but surprise, surprise, it start coming down. So one is forced to close the trade very fast, creating a volatility as the price coming down. It's a beautiful, gorgeous C wave of that flat correction. So A, B, C, that's the flat correction. So talking about how we can combine the flat correction and the volume trading, At the end of the C wave, which is right here, we need to pay attention to the volume bar. We want to check whether we have a surge in trading volume. All right, because a trader was asking me recently to record more videos about how to combine Elliott wave trading and volume trading. That's what I'm doing here. So we have a surge in trading volume, and more than 762 million shares has been transacted at this point here. I have also posted a video before. Have I done it before or not? Let me know in the comment section. How do we set the target? I think one trader was asking me, how do we set the target for the C wave of the flat correction? All right, let me talk about that now very fast. All right, we apply again as we do for the zigzag pattern. Remember, I recorded a video about how to forecast the zigzag pattern. We apply the Fibonacci extension to the A wave, or A for alpha, the A wave of the flat correction. You see, this is the A wave. We apply Fibonacci extension to it. This will allow us to forecast the end of the C wave of the flat correction. The general rule is that very often it can stop at the low of the A wave. So this is the first point. So if the C wave is starting, it can end at the point at the lowest point of the A wave of this flat correction. If that low of the A wave of the flat correction fail, the next target level is the 138.2% Fibonacci extension level of the A wave of the zigzag pattern. That's the orange line here. That's the 138.2% Fibonacci extension level. And here you can understand that the professional traders that are trading the American Express are Elliott wave traders. And as the price came to the 138.2% Fibonacci extension level of the A wave of the zigzag pattern, the C wave has stopped. But don't think that definitely it will always stop there. Sometimes it may not stop there. It can go down to 161.8% Fibonacci extension level of the A wave of the zigzag pattern. Even it can go down to the 200% Fibonacci extension level of the A wave of the flat correction. So if we ask you the question, how do you forecast the end of the C wave of the flat correction? You will say that either at the end of the either at the low of the A wave of the flat correction, or at 138.2% Fibonacci extension, or 161.8% Fibonacci extension, or at the 200% Fibonacci extension level. Okay, those are the three levels that the C wave is more likely to stop. It can go down more, but those are the three key levels: the low of the A wave, the 138.2% level, the 161.8% level, and also the 200% Fibonacci extension level of the A wave of the flat correction. So there are four levels: the low of the A wave, the 138.2%, 161.8%, and the 200% Fibonacci extension level of the A wave of the flat correction. This is how we can forecast the end of the C wave. In this case, for American Express, it has stopped right there at 138, not 138.2%, but at exactly at 138.0, because I always use 138.0 instead of 138.2%. And you can see that it's working beautifully. It did stop right there. Now the question is, how do we combine the flat correction and the volume bar? Okay, hold on a second. I'll be back in a second and we'll talk about it. Okay, what we need to do is that if the financial instrument is in a C wave of the flat correction, we will draw a line at the low of the A part of the flat correction. So I'm going to move this line here. So that's the turquoise line. So we leave a line there. And as the price is going down during the C wave, if you look carefully here, as he was approaching the low of the A wave, which is the first target for the C wave, you can see the tail of that candlestick bar here, this one here. Okay, this one, this candlestick bar here. it got a long tail. Professional push it down. The second candlestick bar also got a tail. And at that point in time, you can see clearly here that we have a bit of surge in trading volume. All right. So you want to observe, the trading volume, especially check if there is a surge in trading volume as the price is coming near one of those four key level where the C wave is likely to terminate, so to speak. All right. You can see clearly here that we have a bit of surge. We have 436 million shares being transacted in American Express stock as the price was retesting, the low of the A wave of the flat correction. Now you have to understand why we have that, because the bearish trader that was selling, professional that was selling, as the price is approaching the low of the A wave, there will be a kind of a profit taking in that zone. So we will expect a surge in trading volume, which means the bearish trader that was selling will come out of their trade by closing some of their position, creating a bit of surge in trading volume. And also on the other hand, the bullish traders that want to catch the new trend, that are expecting a reversal at the end at the low of the A wave. So as the price coming here, we had two groups of traders that were trading here. That's why we have the surge in trading volume here. Those who were selling were closing some of their position to secure their profit or to bank some profit. And also bullish traders that understand the flat correction are expecting a reversal at the low of the A wave. All right here. So it's not sufficient to see a surge in trading volume at one of those four key level. What we need to do, when a price is at one of those four key level, i.e., the low of the A wave, the 138.2% level, the 161.8% level, or the 200% Fibonacci extension level, and then we see a surge in trading volume, we should not quickly assume that those are buyers. We should assume that people are buying now. So that's why you can see that the price, though we have a surge in trading volume, more than 436 million shares, as the price was retesting the low of the A wave, we have a surge in trading volume. We did not have a reversal. So how do we manage that? What we can do, when we see the surge in trading volume, we need to analyze the candlestick bar. Check carefully the candlestick bar. So there's this one was very bearish. Personally, when I'm looking at candlestick bar, I want to check where did that candlestick bar close in relation to the median line of the bar. So you can see this one here, it did close a little bit below the median line of that long candlestick bar. But the following candlestick bar did close above the median line of the range of that candlestick bar. Are you with me? Because I can't zoom into it more than this. So I talked about this one already. Now I'm talking about this one that did close above its median line. So this one here is looking more bullish, as it was piercing through the low of the A wave. So, but then this is not yet a candlestick pattern, because it's just a bearish candlestick bar with a long tail, but it's not the one that we are talking about before. You remember I was talking about a pin piercing through a key level. This is not a pin at all. It just got a long tail. So we will wait for a confirmation, which means this candlestick bar here, it closes above its median line. It will be nice to have, and the following candlestick bar to be a bullish candlestick bar, but the following candlestick bar happened to be a bearish candlestick bar. But in order to control, the trading setup here, suppose you were here, you see, all right, this is exactly what I just was saying. That the C wave can end at the low of the A wave, and we should look at the surge in trading volume. They say, all right, 436 million shares, that's a lot. It will bounce up. Okay, what you need to do at this junction is to implement a different time frame trading method. That's the only way you can control the trade here and trade it like a pro. Because I'm on a monthly chart, traders say, Joe, you're always on a monthly chart. All right, you know that is my favorite time frame, by the way. So you will use monthly chart trading set down, daily chart. So you will go to a daily chart waiting for a signal to buy. But in this case, there was no signal to buy. Therefore, you cannot create it. Don't invent it. Don't fabricate it. All right. If there is no signal, there is no signal, and we can go to another time frame to enter the trade. So by using a different time frame trading method, so when the price is at one of those 4 key levels, and we see a surge in trading volume, one must implement a different time frame trading method. So you may say to me, George, I don't know anything about different time frame trading method. Then I will say to you, all right, YouTube search, okay, multiple time frame trading method by digit 2, digit 4, or 24, okay, by 24 stock trader YouTube channel, or YouTube search a top-down trading method by 24 stock trader YouTube channel, or go to that channel and check videos relating to top-down trading method, multiple time frame trading method, okay. This is what we will do here. But there was no signal, so it continued to go down, so we'll say, all right, it has failed to find a support here. So what is the next level? We'll say 138.2% level. So here it is. It comes to 138.2% level. You see how it came? It came with a bullish candlestick bar. This is very interesting. You see that. This is very beautiful setup here. You see there was this bearish candlestick bar that pushed it down. The following candlestick bar, this one which is bullish, talking about this one, all right, did open here. I see try to go near the 138.2% level, but quickly went up. Why is it going up? Because there were orders here to buy. So after that tiny bullish candlestick bar in the zone, so you can see how it did open here, went down a bit, but pushed it near the median line of the previous candlestick bar that was bearish. It's bullish pattern. You see, he went into the bearish zone. He went into, okay, that candlestick bar that was bearish. He went up a bit. So we will be wondering. So also, you see here, we have a huge, okay, surge in trading volume as it was coming. So in comparison to the previous surge, which was in a zone which was around 436 million shares, you see that candlestick, that surge, the new surge, I'm talking about this volume bar here now. By the way, tomorrow is the 4th of July, so I want to say to my all right, American friend, happy Independence Day for tomorrow, okay? All right. So here we are. So this is it. You see, that's a surge in trading volume. You can see after the first one, we have a new surge in trading volume as the price came near this one. So something is brewing here. So those who try to buy here were taken out of the trade because the smart money say, well, we will prefer to buy here. Why? Look, that 138.2% level, which is the extension of the A part of the flat correction, is also corresponding to the top of this resistance here. You see, they were resisting here. So whenever you are using Fibonacci extension, and a Fibonacci extension key level is corresponding to key resistance level, that Fibonacci extension level is very, very influential. So the smart money say, like, okay, there was a kind of blah, 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 blah consolidation here. Why don't we just bring it on top of the consolidation as we bought it here before, okay, and pushed and buy instead here. So now we have another surge in trading volume as the price approaching the next key support level, the 138.2% level. So again here, always, if the price, if during a C wave, if the C wave is at the low of the A part of the flat correction, and we see a surge in trading volume, what do we need to do? We apply top-down trading method. Here again, we see a surge in trading volume. How many shares? Okay, 663 million shares, followed by, okay, all right, another surge again, all right, 762 million shares. So after that, so Price at the target level for the C wave, we see a surge in trading volume. Check the candlestick pattern. Allow me to say this again because it's so important. If the C wave is at one of those 4 key levels, all right, and then we have a surge in trading volume, analyze the candlestick pattern because this will help you to know that there's a high chance that we may see a reversal. So those who are using the candlestick pattern will be implementing a top-down trading method before everybody else. You see that candlestick bar here, the long one here? Those are candlestick pattern traders that were into the trade before everybody else. All right? But you have to understand what was. So let's not go away from the subject. If the C wave is at one of those 4 key levels, and we see a surge in trading volume, we just implement a top-down trading method. Very simple. That's it. So here, as people bought it, it ran up to the moving F14 because the moving F14 is always suppressing the price. See, during the C wave, that's normal. I was surprised that they push it through like this because I think normally after that first reaction, you need to understand that to retest the moving F14, we should have a bit of pullback. Sometimes the price may form a double bottom or a higher low. I'm very surprised they just push it through. Those are very, very, very ambitious bullish traders. That was in 2009 after the financial crisis. You have to understand what was happening here. The stock market was starting a bullish trend. The S&P 500, the Nasdaq 100, the Dow Jones, all the major indices. Everybody had enough of the bearish time and they want a new bullish trend. And the smart money, a lot of stock. Well, look at this stock. This stock today, look at it. It's now $85. In 2009, look at that. It was at a $12 zone. Ooh, that's very, very good price, you see. $12. All right. So they were oversold, looking at their balance sheet and everything. But the market was bearish that time, and the smart money bought it there. And this is what has happened. All right. So how to combine the flat correction with the trading volume is to highlight the low of the A wave, the 138.2%, the 161.8%, the 200% Fibonacci extension level of the A part of the flat correction. If there is a surge in trading volume, one will implement a top-down trading method. Okay? That's it. So now, as they start buying here, normally, as I was telling you, we should see a bit of pullback, but it didn't. They push it through. Price start going now. So we will say that a new trend is underway. How do we count wave here? So traders say, Joe, you can't wave too much. How do you polish your area wave count? By practicing. So I'm going to do a bit of wave count again. All right. So we talk about it. So what is the first wave here? So you start pushing now. So your flat correction is completed. Okay. As an Elliott wave trader, you see the surge in trading volume, blah, 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 blah. And then you are wondering, okay, a new trend is underway. And then you are wondering, where is the first wave? So now, where is the first wave? I'll leave it to you for a second. Where is the first wave? If you're having difficulty to find the first wave, it means that you need to go to www.24elliottwave.com and click on Wave Count Guidelines. We have an inverted head and shoulder chart pattern here, and this is helping us to determine where's the first wave. It's the first wave right here. Feel free to disagree with my wave count. A trader that I've been following, I know what I'm going to say now, and I will say what? Now this is my wave count. So, okay, let's color that into green, okay? Stay with me, please. Don't go away, all right? We are talking, we are discussing, we are having good time as Elliott with greedy traders. All right? So I'm trying to find a nice color. Okay, I'll use dark green, okay? Can you see on my chart? That's the first Elliott wave from here to here. And this is, so we have an inverted head and shoulder chart pattern. This is the first wave, the second wave. Did you see that? Did you recognize that this is the first wave? All right, if you didn't, it means that you still need to practice more and more. Nothing wrong with practice, all right? Even professional practice. So this is the first wave, this is the second wave. I've done a bit of homework, so I can go very fast to avoid that the video is too long. Now we are now in a third Elliott wave. That is a complex third Elliott wave. subdivided into 5 monowave. Is it too long? Am I wrong here? I can be wrong. Don't think that I can't be wrong. I can be wrong, all right? So first wave, second wave, third wave very extended, all right? Let me check something very fast. I want to see what type of, want to apply Fibonacci extension to the first wave. It's a very extended, okay, third wave. Am I wrong? Maybe I'm wrong here. Let me know in the comment section. Maybe I'm wrong. All right, okay. So first wave, second wave, third wave, subdivided into 5. 1, 2, 3, 4, 5. Okay, followed by a tiny fourth wave that's subdivided into 3. 1, 2, 3. Can you see it? Can you see that fourth wave? One candlestick down on the monthly chart, followed by another move up and another move down. That's our fourth wave that is subdivided into 3. Now this is my preliminary wave count because in order to validate this wave count, I need to go to the higher time frame and do all kind of contortions. All right. So this is the fifth wave, tiny fifth wave. So this is my preliminary wave count. Don't be too strict with me with this wave count. If I'm wrong, that just laugh a bit. All right. Just laugh a bit, not too loud. All right. So first wave, second wave, third wave quite prolonged. A fourth wave and a fifth wave. Is this a trend? That is the question. So now what we need to do, how do we know that this is a trend? How do we know? Can we call this one a trend? We need to apply what? Fibonacci extension to the prior multi-wave. All right? And which level are we going to highlight? We'll highlight the 138.2% Fibonacci extension level. Why? Because we want to, if there will be a new trend, that new trend must break above the 138.2% Fibonacci extension level of the prior trending phase. And it did break above it, so we'll call it a trend. All right, I have not finished yet. Stay with me, please, because we have another flat correction. All right, here we are. So our fifth wave has ended here. A correction has begun again, and that correction, surprise, surprise, is again a flat correction, but a very tiny one. Can you see it? So I will put a bit of color into it. You see, it's 1, 2, 3 down. Sometimes you may not see the internal wave clearly. This 1, 2, 3 down. Will you agree? Let's put a bit of color into it. Orange. That's a flat correction right there. So what I'll put in here, you can see the tail of that move down. That's what I'm trying to cover. I want you to see it first before I put it back there. So that's the 1, 2, 3 move down. Hold on, please. Let me put it all the way to the. That's it. And then here it is. We didn't see this one. Is not very clear. The one, another 1, 2, 3 up is not very clear, but we know it. Okay. And then, though, look carefully, my friend. Though normally, if you are expecting a flat correction, we'll expect it to go a little bit above. Okay. The fifth wave, yes or no? All right. We'll expect it to go up to the 138.2% Fibonacci extension level of the fifth wave, as I did before, okay, in this section here. All right, you remember? So here, if we were talking about expanded flat correction, we will expect the B wave to go to the 138.2% Fibonacci extension level of our new fifth wave. But here it did not. But surprise, this is what I've said to traders before, because sometimes the area wave theory, there sometimes we have surprise, and things differently are happening, and this is the, all right, the C part of our new flat correction. Okay, this is the C part. So this is a flat correction, a tiny, distorted, squeezed. All right, it's not very clear. If I am wrong, don't. Okay, I will say to you this is my wave count. All right. Okay, so after that tiny, still a strong trend as such, all right, all the way up there. And then we have 1, 2, 3 up, and then a move down, all right. What I'm going to do now, because we are talking about the flat correction and the volume trading, we want to see what's happening here. So how do we set a target again for this C part of the flat correction? So your first target will be where? At the low of the A part of the flat correction. You see those candlestick bar here? Can you see? You push it down and they say, whoa, that's the first target. Okay, you see the tail here? But the bit of consolidation here is to acknowledge that level. So that's the low part of the A part of that new flat correction. And then what do we need to do? Now we apply Fibonacci carefully. Do it correctly. If you apply Fibonacci extension to the A part of the flat correction, try to make sure it's done accurately, like Lavoisier. All right, do it accurately. Try to do it accurately. All right. Okay, now we apply Fibonacci extension to the A part of our new flat correction. And which level do we need to highlight? You get it now. Okay, I'm not going to draw. I'm just going to move this line. 138.2%. Surprise, surprise! Look how they were coming down. See? All right, that's the 138.2% level. Can you explain to me why this candlestick bar is too long? Can you understand why? Do you know why this candlestick bar is very volatile? It's because people were buying here. People were buying here and they were taken out of their trade. Why were they buying here? They were buying here. Why? Because, you remember, the previous C part of the flat correction did stop where? At 138.2% Fibonacci extension level of the A part of that flat correction, yes or no? So as the new flat correction is underway, and it came to the 138.2% Fibonacci extension level of that new flat correction, professional traders that were trading this stock were expecting a reversal here. Some of them were expecting a reversal here because they know that some stock will do exactly the same thing over and over. 138.2%, they will change direction. 138.2%, they will change direction. So the stock traders understand that there are some phenomena that are quite repetitive in the financial market. Some stock will do the same thing over the year. But the problem is that sometimes traders don't even pay attention, but professionals do pay attention. So what has happened here, the reason why this candlestick bar is very long is because it is normal for traders, Fibonacci traders, or area weight trader, to expect a reversal here because something that has happened before. You remember Ecclesiastes, all right? There is nothing new under the sun. All right? What has happened before is likely to happen again, and this is true in the financial market again. And we see that's why I love the fractal pattern. All right? So because has happened before, the stock did change at 138.2% Fibonacci extension level of the first A part of the flat correction. Now, as we have a new flat correction, it's normal. The first thing that should come into their mind is to buy at 138.2%. Did we have, the question now is, do we have a surge in trading volume? No. Can you see a surge in trading volume? Let me place a vertical line there and tell me if there is a surge in trading volume. No, there was no surge at all. There was no surge. You see now? So will you agree, my friend, will you agree with me for the first time in your life, if you have been disagreeing with me, all right, that there was no surge in trading volume? Will you agree that by combining the flat correction with the trading volume, we can improve, our area of trading? I think many traders will agree. Here, there was no surge in trading volume. So the mistake that those who were buying here were making is that there was no demand to buy this stock at this junction. The smart money was not interested to buy. So, but contrary to the previous retest of the 138.2% level, we have what? A huge surge. Even before that, when it was retesting the low of the A part of flat correction, we see a bit of surge. But in this case, there was no surge at all. And you know what? The contrarian traders love that. If they see that, you know what the contrarian traders are doing? When they see that other traders are making mistake, they will come and punish them. And this is the contrarian traders coming here. As they see those orders to buy here, those crazy orders to buy here, they slow them down. Phew! Look what has happened. Now, because of all those stop loss that were piled, am I speaking proper English now? All right. Because of those, stop loss that were piled in these regions, all right, okay, people were expecting to catch a new trend. So, but this is what we are talking about. This is what we are talking about. I don't want the video to be too long. I can go on and explain more about this chart. And so they may say, Joe, you're repeating yourself, but there are more to this. Why suddenly we have all this mess here? Okay, now, without too much blah, blah, blah from my side, let me go over it very fast. Those stop loss were taken out, creating a huge move down very fast. In this time, even the 200% Fibonacci extension level couldn't save, this stock. It pierced through it. But another mistake that traders are making here is because there was no surge in trading volume, and those who were buying here were not using what? A top-down trading method. We can say that they were not trading like a pro. If they were trading like a pro, they would use a top-down trading method. They were just buying. Those are ordinary investors. Sometimes will buy because the fundamentals are improving, blah, 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 blah. But they have difficulties to time the market. And sometimes the most sophisticated market participant will punish them, or the contrarian trader will come and punish them. All right? This is what has happened here. It's a sad situation. That's why I keep talking about top-down trading method, different type of trading method. In every video, traders say, wow, you talk about the same thing all the time because it's so important, just so important. And we can't ignore it. Okay, we can't ignore it. We can talk about it all day long. And it's just so important, all right? So this is what has happened here. So it pierced through the 200% level, didn't even find support there. Went to which level? Can you believe this? At 238.2% Fibonacci retracement level. Have I said that 138.2%, 238.2%, the 338.2% are key, are critical Fibonacci extension level? Have I said that? In a video that I recorded recently about mastering the 214% Fibonacci extension level, all right, at the Day Pro Trader YouTube channel. Those are critical, all right, support and resistance level. 238.2%, 138.2% level, all right, 338.2% Fibonacci extension level. So it pierces to the 200% level. So where is he going? He's going to daddy at 3-1. But one thing, what I was saying to you, anytime you see this is not bad place, the 200% is not bad place. Why? Because it's corresponding, is coinciding with another key level. We have the 200% level coinciding with a normal key level. So when you are using a Fibonacci extension level, pay attention to those Fibonacci extension level that are coinciding with a normal, a key level. So this is good. You see the 238.2% level, all right, is also coinciding, all right, am I speaking nicely to you? Okay, with another key level. Can you see that? It's a key level here. It's coinciding with it. So the smart money prefer those key levels because when a Fibonacci and a normal key level are matching, they become powerful, and the smart money love those key levels. You need to be aware of that. Otherwise, sometimes you'll be surprised. Why? I'm very surprised that this stock couldn't find support here. But the reason, one of the reasons is because there was so much stop loss piled in this zone, and as those stop loss all right, were taken out, the price crashed down, all right? But that situation could be avoided, okay? That situation could be avoided if they allow the price to go gently to the 200% level. But people try to be outsmart the market and buy straight away. Here, look, that level of, where were we? Oh, in fact, we were here. 138.2 is here. Why is this one here? It's coinciding. Yes, it's coinciding. Here it is. It's coinciding with a key level, which is good also. But we did not have any surge in trading volume. This is the mistake that they're making. No surge in trading volume, and people did not apply a top-down trading method, and the price crashed down. All right. So now we have another flat correction. What's going on here? Where is the first wave? I leave it to you to find that the first wave. Are we going to have a new trend, or are we going to have a complex correction? Do we always have a new trend after a flat correction? No. We may have a complex correction, we may have a flat correction followed by a next wave and another zigzag or triangle. It can be a messy complex correction. All right, so don't assume that anytime we see a flat correction, a new trend will definitely be in place. All right. So this is the end of our tutorial. To summarize this video to you clearly, we are using the flat correction, the internal wave at 335. If we want to focus the end of the C wave of the flat correction, we apply Fibonacci extension to the A wave of the flat correction. We highlight the low of the A wave, the 138.2%, the 161.8% level, and the 200% Fibonacci extension level. Now, how do we combine the Fibonacci, the flat correction, and the volume trading? If the price is at one of those 4 key levels that I already mentioned, we will check the volume and see whether we have a surge in trading volume. The surge in trading volume doesn't mean that we should buy straight away or sell straight away, all right? It means that now we must implement a top-down trading method to trade it. If the financial instrument reaches one of those 4 key levels and there is no surge in trading volume, we need to be patient. One will also pay attention to the candlestick bar, candlestick pattern that are formed in the vicinity of those 4 key levels. So if you have a bullish candlestick pattern, a surge in trading volume, all right, we will now implement a different time frame trading method to trade it. All right. I hope you will find this video useful and will put it to use to improve your Elliott wave and flat correction trading. As always, my friend, if you have any question, all right, feel free to put in the comment section, and in due course, I will be recording another video to answer your specific question. I have been recording this video today because a trader did ask that question about how we forecast the C wave of the flat correction. So you see now, I have not forgotten you. For our American friend, I want to take this opportunity to wish you for tomorrow, a happy Independence Day. For other traders, all I will say to you, happy trading to you all, and speak to you soon. Until the next time, enjoy yourself and be very happy. We are the GSTW24 traders talking about how to combine the Elliott wave flat correction and volume trading like a pro. Speak to you soon.